Hello, I am Dr. Jeffrey Tickell from Indiana University of Pennsylvania, and this video today I'm going to do an overview of Chapter 8 from our textbook in Accounting 202, where we talk about relevant costs for short-term decision making. Alright, so there's a few aspects of this topic. We've got relevant costs. What does that mean? We've got short-term decision making. What does that mean? Alright, so what we've got when we talk about short-term decision making, if you're making decisions about anything, then obviously what you have to do is have choices. Right? There needs to be more than one choice before you can make a decision. Okay? So decision making occurs when businesses have choices. That is more than one option to consider. For example, and we'll talk more about this later, but one business might decide, do we continue to make a component in-house or do we outsource it? Okay, so business decisions need to have information to support each choice. So when you have different choices, maybe option A, okay, provide the information that goes with option A, and then option B, and then you provide the information for that option. Okay, and then the management has to decide which option do they go with, option A or option B. So the job of the management accountant is to provide all of the information that will support option A or support option B as to which way management should go. Because what we want to do is allow managers to make informed decisions. Very important that we provide the information for managers to make informed decisions. The information should be relevant, and it should be relevant to each option. Alright, so that's the aspect of decision making, right, where you've got choices. The other aspect is short term. What is meant by short term? Okay, now if you've done any microeconomics, you'll know that short term is where at least one cost is fixed. At least one cost is fixed. Okay? The other aspect, of course, is long term, where all costs are variable. So what we're doing here in the short term, at least one cost is fixed in those options, e.g. rent of the factory. Alright, so we've covered decision making, short term, what are the relevant costs? Okay, so the relevant costs are those costs that are relevant to each of the choices. And typically what happens, we ignore the fixed costs. Okay, we look at the costs that are different between the two options, and where the costs are the same between the two options, we ignore those. And those costs will often be the fixed costs, because fixed costs don't change when you change output. Alright, so this topic covers the concepts and processes behind short-term decision making. That is where a manager has options and when some costs are fixed and committed. Alright, so they've got to pay those costs whichever way they go with the option. Now we might go option A or option B or none at all. Okay. Now costs that are the same for all of the options are not relevant to the decision. Therefore fixed costs are typically not relevant and not included in short-term decision making. Now in our Accounting 202 classes we focus on 5 short-term decision making categories. Okay. And those 5 I'll go through right now. The first one we talk about is called a special order. Okay? Special order. Now I'll give an overview of this, but in another video I will provide a worked example of how we work through a special order question. Special order is where we might sell our product to a customer in a bulk order situation. For example, the customer might say, I want 1,000 baseball caps, okay, to sell at the next event. And so we have to make 1,000 of them and sell them to the customer at a discounted price. And that would be a special order, because with a special order, it's usually just a one-off order, just a one-off situation. Okay, the other topic that we talk about is what's called discontinue a product or a department or a division. Okay, discontinue. And the reason that management might consider discontinuing a product, a department, a division or a store is because it might be making a loss. And so management feels if they close that division down, then they'll avoid the loss and their overall operating income will increase. But it's not as simple as that, okay? Because by discontinuing that division, they actually might reduce their operating income and not increase it. So we'll look at that in a moment too. The third one is called which product to emphasize when you have constrained resources. Okay, so when you have different products that you're manufacturing and you've got a constrained resource, which product do you emphasize? And the rule generally is we emphasize that product that gives us the highest operating income for that constrained resource. And the constrained resource might be skilled labor or it might be machine hours. Okay. Now the fourth one is to what's called a make or buy decision. Do we make it or buy it? Okay. So when we make a product, we call that in-house. When we buy a product, we call that outsourcing. Okay, so quite often a business might be making something in-house, but they look at the options of buying it from an outside source, and they feel that if they buy from outside, they'll actually save money because the outside option sounds like a cheaper option, okay? Less cost. And the fifth one in this overview that we'll talk about is whether to sell a product as is, so as is, or to process it further and then sell it after we've processed it further. And a good example of that would be like a business might manufacture milk, okay, but if they process it further, they can turn it into yogurt, and so therefore they will make more profit out of the yogurt rather than the milk. And again, we have to make a decision on that. Okay, so there's the 5 types of relevant costs for short-term decision-making topics that we'll cover today in this quick overview of the video. All right, so in order again, we're going to go with special order. Now, the overall aspect of this topic is that we should go with the option, in all cases, all 5 of those cases, we go with the option of which one provides the highest operating income. Okay, so which one will give us an increase in operating income and by how much? And we probably will go with that option as to the one that gives us the highest operating income, but we do have to take into account what's called the qualitative effects of any decision. The qualitative effects, and that could be qualitative effects such as what's the effect on employees if we make a decision to outsource? What would be the effect on the local community if we made a lot of workers redundant? What would be the effect on the customers if we accepted a special order and sold our product at a discounted price to one particular customer versus the other customers? And so we've got these qualitative effects to take into account as well. Okay, so we always keep those in the back of our mind when it comes to short-term decision making. Okay, starting just before we start with the special order topic, we always have to remember sunk costs. Sunk costs, which are costs that you've already paid for and you can't get the money back on those, they are always not relevant in any decision making. Okay, give you a quick example. For example, you might have put new tyres on your car, and then a month later you decide to trade in the car, and the new tyres might have cost you $800, and you say to the dealer, well, it's got new tyres on it, you should give me a higher trade-in. And the dealer says, look, I can only give you what the market value is, and it doesn't matter whether it's got new tyres or old tyres. I can't give you any increase in price. Okay, so the $800 that you spent on your new tyres is a sunk cost, and it won't be included in the decision making. So sunk costs are always disregarded when it comes to working out which order we go with, which option we go with. Okay, so let's have a look at special order. So this is where a customer, often a new customer, requests a one-time order at a reduced selling price for a bulk purchase. For example, US Masters Golf, the Augusta National Golf Club might go to Nike and say, look, we'd like to buy 10,000 golf caps. We'd like you to put our US Masters 2020 logo on it, and we'll buy them off you, all 10,000, we'll buy them off you at a lower price than what you normally sell to your customers. And so Nike has to consider a couple of things with that. With any special order, you look at these options. First, does Nike have the capacity to fill the order? Okay, in other words, in their factory where they make their caps, do they have enough leftover machine hours, material, skilled labor, all that, to actually fill the special order? That's the first thing. If they do, then they go to the next step, right? And that is, does the selling price cover the incremental costs? Okay, so whatever Augusta National Golf Club has offered to buy them from, can Nike cover all of the costs in those? And in that case, we're only looking at the incremental costs, which is usually the variable costs and not the fixed costs, because the fixed costs are typically covered in their normal orders, not this particular special order. And the third thing to consider is, will the special order affect their regular customers? Okay, which means that, what that means is, if other companies hear about the special order price, will they approach Nike and say, look, we want you to sell us caps for the same price that you sold Nike to? Okay, and so Nike has to consider all of those options with a special order. Now, they'll go with a special order if they can cover these three aspects. Yes, they have the capacity. Yes, it will increase operating income. And no, it will not affect their regular customers' orders. Okay, so that's the special order. Next one, discontinue a product, a division, a department, or a store. Okay, so number 2, discontinue. Sometimes businesses want to close down a division because it's making a loss. When they look at the overall aspect of the business, they find that one division is making a loss. But what management has to consider is, what's the overall effect of closing that division down on operating income. Okay, so the overall effect on operating income. Because what might be happening with this business is, because they're making a loss, the loss might have come about because they've shared the fixed costs for the whole organization. And if you take off the fixed costs from that department, they might actually be making a profit. And therefore, if you close down the division, those fixed costs move from the division that was discontinued to the rest of the organization, and so their operating income might actually fall. All right. So what we look at there is there a positive contribution margin from this division? Does this division contribute profit in the contribution margin, in other words, selling price minus the variable costs. And if they are contributing a positive contribution margin, then it might be best to keep them open. Okay, keep them open. All right, so if the division has a positive contribution margin, then we'll keep the division open in the short run, because if it was to close, then the operating income would probably fall. And again, I'll work through a problem with that in a separate video. Okay, so then we get to the third topic of this short-term decision-making video, and that is which product to emphasize when you have constrained resources. All right, now the constrained resource could be a lack of skilled labor, okay, or it could be lack of machine time. Maybe they don't have a machine large enough to cover all of the manufacturing that they have to do, and so you've got to emphasize or determine which one to emphasize. Do we go with the product A or product B? And the answer to this is you go with the product that will provide the maximum contribution margin per the constrained resource. Okay, the constrained resource. All right, so in other words, a decision needs to be made as to which product to emphasize, and the answer is the business should emphasize the product that provides the highest contribution margin per the constrained resource. And again, I'll work through a problem with that in a separate video. Number 4 of our 5 topics: make or buy. Okay. A business might make a component for their product. For example, General Motors might manufacture their own windscreens for the Chevy Impala in-house, but they look around and they decide that they might actually save money if they buy it from a windscreen manufacturer, a glass manufacturer such as Pittsburgh Plate and Glass. Okay, and so the question they have to make a decision on is, do they continue to make it in-house, or do they buy it from the outside supplier, which is called outsourcing? And what the answer will come down to is which approach, whether they keep it going in-house or whether they outsource the production, which one increases operating income. That's the bottom line with most of these questions. Which one will increase the operating income? And we have to be careful that we only include the incremental costs and revenues, okay? Because what we want to do is look at what costs are involved in making it and what costs are involved in buying it from an outside supplier. We also have other qualitative issues to take into account. For example, what's the quality of the windscreen or the product? What's the reliability of the manufacturer? Is there a potential for cost increases from our supplier? And what do we do with the workers who used to make the windscreens, but now we don't need them anymore because we're buying the windscreens? All right. And the last one, number 5 of this topic in the overview, is to sell as is or process further. Okay, and once again, it comes down to what's the overall effect on operating income. Now, if you sell as is, what will that operating income be? Or if you process further, what will that operating income be? Okay, so you're looking at the revenue minus the expenses to give you the contribution margin. Okay, and so you want to go with that stage of production, which gives you the highest contribution margin. Okay, because the higher the contribution margin, then the higher your operating income. And I'll give you a quick example. You might have a business that makes a product such as milk, and they can sell the milk as is and make a profit on that, or they can hang on to the milk, some of the milk, and turn it into yogurt, and then they can sell it at a higher price. some extra incremental costs in making the yogurt, but they can sell it at a higher price and therefore make a higher profit. So the question then becomes, which product provides the highest operating income and how much of each product can they sell? So you'd want to look at, can they sell all of the milk? Maybe not. Do they process some further? Can they sell all of the yogurt? And so you have to look at the market. That's sometimes called product mix. Okay? How much of the product do we leave as milk and how much of the product do we turn into yogurt? So we look at the selling price, which is the revenue minus the variable costs. We consider the incremental revenue and the incremental cost of processing the product further. Will that process increase the contribution margin? If so, you process further, and as long as you can sell everything that you process further. Okay. So as I mentioned, I'll work through the homework questions relating to this topic in a separate video. That's Chapter 8 for Accounting 202 students. And by working through the Chapter 8 homework with me, you'll learn the process of identifying the relevant and the not relevant revenues and costs and determine what effect they have on operating income. Generally speaking, a business will go with the option that provides the highest operating income. So thank you for listening and looking at my video, and keep an eye out for my Chapter 8 homework video. All right, thank you.